Ken's question. I was asked a question about this during a coaching session this week, today, as a matter of fact. But there's another question alluded to yesterday regarding this. Ken simply says, is next week a good candidate to not do any trading because of the election? Ken, I actually think you might be okay doing positions next week. If you're going 1 week out or 2 weeks out, sorry, let's just take Microsoft here. If you're going, trading options on October 23rd or October 30th, 14 days out, I think it might be okay. Now, let me preface that. We know that a lot of news, a lot of ideas, a lot of, what was the term they were throwing around the other day? October surprises could come out between now and the election, which might cause hesitation in the market. We know that here in the U.S., of course, the president, the administration said, yes, let's go big or go home with a new stimulus, get it done. And we know that the House is holding their ground with a certain number they have in mind and certain projects that they want to do. And meanwhile, over here in the Senate, McConnell said, no, I'm going to put my own up that's $500 billion. We're going to vote on that. I'm not even talking to you guys about whatever 1.82 or 2.2 trillion you think you're going to agree on. We're not even tabling that right now. But anyway, if, little things like this, Ken, if the administration and the House comes up with a deal that they want to vote on the House floor and the president says he's going to approve it, you might see a snap in the market to the upside. That's true. This is the hesitation. Trading in this cycle. And we talked a little bit last week about the volatility skew. And I'm going to go back into the volatility skew tool very quickly. We're going to look at time skew. And we'll just use a bellwether. We'll just use Apple. I could use Microsoft as well, but I don't think it's as volatile. But yeah, let me just use Microsoft. And I don't think I can shorten this. I'd like to, but I can't. But you sort of see what's going on here. This is November 6th. This peak of implied volatility is at November 6th expiration. Next week and the week after are still relatively low. And then there's this giant spike here. And I think maybe this is twice. This might be the earnings, the first one. And the second one that's just as high is the election of November 6th. But see, then things trail off because the events are done. Now, someone says, well, this is the perfect time to be selling. Maybe consider a short straddle. We talked about this last week, so I'm not going to go too in depth. A short strangle, a short straddle, a butterfly, an iron butterfly, or an all-call or all-put butterfly to try to take advantage of these shorter-term volatility spikes if the market doesn't move. Well, I've already mentioned here, I use Microsoft for our example. This is a bad idea because I've got earnings coming up on the 27th or 29th, and then a week later, we've got the election. So yeah, you're taking advantage of a fair amount of volatility compared to where it normally is, but we could see wild swings this direction or this direction, which could remain in large losses in a naked short strangle or naked short straddle. So if you're looking, if the market hopefully will be relatively calm for the next week or two, Ken, that doesn't mean it's going to be. It could be relatively calm, which means standard positions, out of the money positions, maybe a bull put credit spread on a stock that does not have earnings between now and expiration, maybe an iron condor for the 23rd or maybe even for the 30th on a stock that doesn't have earnings before the election might be okay. Extending to try to do a trade down to November 20th expiration, especially taking a directional credit spread or debit spread, and I wouldn't want to be short necessarily to take advantage of implied volatility, like we saw with Eileen. Even though the cost is high, you might want to look for something that can profit in both directions. This long straddle, synthetic long strangle, or long strangle itself, buying a call and a put. But they're going to be expensive because the whole market knows that anything after November 6th is likely, any expiration after November 6th, Ken, is going to be vastly affected by the election. It's going to be affected potentially by earnings even after the election. A stock I was looking at earlier today has earnings on November 13th. So at least it's not before the election. But if I chose November 20th, I'm still crossing two volatile events. Okay. And so what does that mean for my long call and my long put if I did a straddle or strangle? It means after the earnings, I'd expect the volatility to fall about 25-30% from where it is. And after the election, it's going to drop another 25 to 30%. So my volatility is going to be down 50%. If I haven't seen the movement I need in either direction yet, wild swings one direction or the other from the earnings and from the election, then I might be at serious loss, even with the stock not moving too much, because that volatility is going to collapse. The implied volatility of the options is going to collapse. So I think good, stable, potentially in the money covered calls might be a good idea, but what can we not control, Ken? I can't control, you can't control either. I wish we could. And if I could, I would let you guys know, but I can't. So any kind of structure, a covered call, bull put, credit spread, anything that's directional, there still could be news coming out prior to the election that could cause the market to slump, cause the market to swing wildly up or more. If some of the bigger stocks, hey, like Microsoft and others, start reporting their earnings on the 27th and 29th, and they're all extremely positive, that could lift the tides. That'd be great for a covered call, might be bad for a bear call credit spread. Protection is key. I think maybe even what we talked about here, that those conservative approaches with the married puts, even if you don't go as far out as time as I normally do, out to 6 months, out to 8 months out in time with the married put position following the radioactive trading techniques. That's my approach, but all my positions only have a 3, 4, 5% risk. In that case, I might be okay opening some of those. I might be okay doing a long collar position instead of the covered call, where I'm still getting premium, let's say till October 30th. I'm selling a call for October 30th expiration, but buying an out of the money put, still might be looking at a 2 or 3% return to the upside with capping risk to only 4 or 5% to the downside. I'm not taking anything speculative right now, such as just buying a call by itself directional or buying a put directional, because it's going to be swinging back and forth, and there's a lot of volatility, especially to the expiration, after that, after the election, anything after November 6 elections. I think there's still good time to do good trades, not worry about it. Now, the gentleman, I'm going to be honest with you. The gentleman I had the conversation with today on the coaching session, he's more into long stock positions, Ken, and just learning covered calls. He's getting really into covered calls. He's done a few, but he's really learning into them as well. But he hasn't done any spreads. He hasn't done anything along those lines. Our conversation was, how can he best hedge his stock positions, his stock portfolio with the events coming up? Well, in the blog and recent webinars that we've done that are available, you can find them on YouTube. If you just go to our YouTube channel and search portfolio insurance or stock insurance, for example. Let me go to options concepts here. How to hedge your portfolio with broad market put options. We talked about this again in September. Hedging leverage positions in your portfolio. That's not there it is. I'm sorry, Ken. Analyzing hedges on large portfolio exposure. All right. So where am I going with this? Well, I was telling him that there are ways that you can look at and use the tools on Power Options to help you sort of determine what puts might be the best to buy for you based on what your expectation is of the stock falling in price or the market falling in price, how much you want to hedge. So if I think SPY might drop 8%, let's say, Ken, after the election, well, I'm not going to try to hedge the entire 8%. That's unreasonable. I want to hedge half of that. I want to, hedge so I'm only losing 4% or 50% of the market drop by buying puts on SPY or maybe QQQ if your stock portfolio is heavy into tech stocks. Okay, VIX and UVXY, buying VIX calls and playing volatility might be a way to hedge your portfolio as well. But if we're in more for, that's great for these sudden events that might cause a stock to swing, but it's risky too in that case, because if it just gradually moves down, your stock might have a sudden swing down, but the market as a whole is gradually moving down. The volatility is not going to be as affected. And that's what happened in September. Buying calls on the VIX, the volatility index, and buying shares of UVXY playing volatility as a counter market did not work as well as just buying puts on SPY, QQQ, or IWM, because that was a gradual decline over that 3 to 4 week period. It wasn't sudden in 2 or 3 days, where the VIX options and volatility plays would really help you as a hedge. And the important thing where I was going with this, Ken, is that during this part of the discussion, the investor I was talking to is my 11 o'clock this morning, he said, well, another consideration, Mike, do you think is reasonable, is to just sell out right now of 60 to 70% of my positions, because over the course of the year, I'm looking at a 12% profit by doing some of the things he's found in power options for ensuring stock positions and protecting against losses and generating some income. He says, is it okay to just close those now, realize most of that 10 or 12%, leave some small positions open, and then jump back in maybe after November 10th, November 14th? And hey, I can't fault that. I really can't fault that. He's taking his profits off the table from this year, staying on the sidelines till the known events with unknown outcomes pass, and then looking to come back in. But there are a lot of stocks that don't have earnings coming up between now and the election. You might still be able to do good, reasonable plays. I'd lean towards protection just in case of the unknowns and the potential surprises coming up between now and the election. Married puts, long collars, you want to play the short side, you could do the married call position, or potentially the short collar as a start that we looked at for Eileen's position as well. I might be doing bull put credit spreads next week. It depends on what happens over the weekend. And my bull puts might be 10 to 14 days out in time, about 11 days out in time. I wouldn't hold them through that time period. I wouldn't hold them through the election or have new ones open as well. William made a comment. I think you're related to this too. William says, what about ETFs that don't have earnings? That's a very valid point, something I didn't consider until right now, William. Thank you. What he means by that, Ken, is that ETFs, of course, we know might move after the election or leading up to the election. William says, what about ETFs that don't have earnings? Sure. I could maybe look at a long collar position or a short collar position on SPY or something similar to that. A married put on an ETF as well. For something along those lines, shorter term, or even perhaps a covered call. What is key in that case is to make sure, William, that if you're looking at a standard ETF, you know you're pretty safe, right? SPY, QQQ, you know that QQQ is heavy into some of the bigger tech stocks that we all know by name, but making sure that those stocks potentially don't have earnings coming up between now and the expiration use cycle for an out-of-the-money naked put, covered call position, or collar. Because, if I did one stock, but unfortunately 9% of its holding, I did one ETF, William, and 9% of its holdings are in one particular security, and that particular security has earnings coming up on the 23rd, and they bomb, it's going to drag that position down. So you do have to pay attention to that, but a lot of times you don't see that high of an allotance, is what's the term I want to use there, but that high of an investment into those positions. Okay, into those standard ETFs. But it's a good idea because they're more stable. But first, Kipp. Kipp says, one of the problems with the election as an event is that it might be drawn out affair with no clear winner, thus drawing out event for an unknown period of time, thus increasing the level of risk. A possibility. I don't expect it to last too much longer, but I hear you, Kipp. I hear exactly what you're saying. So it could be drawn out, and the effects of knowing the winner or loser could also be drawn out, and other things can happen after November, even when a winner is selected. Other policies could still be implemented, of course, in November and in December, depending on the outcome of certain things. Senate, House, more. We know that's all gonna still be a couple months of where we are right now, and that might be okay. But things might get pushed through that would also affect the market in that case. So it is something to keep in mind too. We're in for some bumpy roads through 2020. Don't get me wrong. It's not over with after just the earnings in the election. There's still more to go. But, as you mentioned, Kipp, at least we'll be through those two events. The volatility, unfortunately, it may be good. In theory, the volatility should dry up after those known events start to pass through, Kipp. But if the market takes an ill effect to the results or the outcome of earnings, even, volatility might go up more than we're expecting, which you can say might be good for selling. But whenever you sell, what do? You get into a direction. And if it's going the wrong direction, it doesn't matter how you sell. Yes, you're collecting implied volatility. Yes, you're playing the implied volatility game. But if you pick the wrong side and you pick the wrong direction and it's moving against you, you're still in the place for some losses there as well. All right, so I just want to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or direct trading suggestions. I'm not saying that you should go out and buy a married put on Kraft. I'm not saying that you should go out and look at short positions on Microsoft or short collars or long collars. I'm saying that, hey, a good position with a good controlled risk and a potential upside going through known events with unknown outcomes is a good structurally trading idea. Controlling risk to single digits is a great idea in unknown events, but we're going to be going through a lot of volatility as well. As we've seen, options do involve risk, may not be suitable for all investors. Oh, I hate when it does that. My apologies, ladies and gentlemen. There we go. Now, today we saw some examples of the search tool, different functions you could use. We saw for Fernando how he could quickly create a screen just to look for the lowest volatility, implied volatility on a particular option. But in every of the 23 strategies we support, you've got over 20 to 25 different option criteria you can screen and filter by, as well as 15 to 20 different stock criteria as well. To find just the positions that match your personal risk reward tolerance. Took a look at the portfolios a little bit today, volatility skew, some of our signature tools we looked at. In any case, you're looking for a good set of tools for a self-directed options investor, a one-stop shop for what your needs are. Test it out for free. Go to powerop.com, just put in your name and email address. You have full use of the site for 14 days. The patented search tools, research tools, some of those signature tools, the portfolio, plus access to a lot, most, nearly all, of the archived webinars for the strategy discussions, management techniques, and much, much, much more. Full 14-day access, no credit card required as well. Now, after that, the subscriptions start at just $45 per month. And any subscription level, you can cancel at any time. There's no contractual obligation for X or Y amount of months. I mentioned a coaching session that I had earlier today and yesterday. Power Options trial members and subscribers can schedule a free coaching session at any time. They'll be either with Ernie or myself. We'll walk you through the tools on the site, discuss strategy, how to use the tools to implement the strategy you're considering. You can also upgrade at any time as well, and subscribers get full access to all of the archived webinars. As I mentioned, other free stuff, the archive webinars page, we saw a little bit of that today. That is a public page. Just go to poweropt.com/webinars.asp, and you can toggle through the different categories. Also, you can check us out on YouTube. Just go to YouTube, look up Power Options. While you're on Power Options, you can use the search. So you can just search for ratio spreads, search for stock insurance, portfolio insurance, and you'll quickly see all of the videos that we've done recently and in the older times for those particular discussions and questions as well. Of course, you can also check out the blog on poweropt.com and our Learning Center for other articles and educational resources. Well, William says thank you there. Thanks again. All the best. Have a great weekend. William, thank you for your questions as always as well. You have a fantastic weekend. Kipp, thanks for a great session. Have a great weekend. Kipp, thank you. And thank you for bringing up that other comment earlier. It is very, very poignant and correct that we could be experiencing 30, 40, 50 days of uncertainty even after the election passes. But coming up there, we know we're heading into volatility, and that volatility is going to decay, or it might increase if we have wild, unexpected swings we're not prepared for due to any earnings surprises, massive earnings surprises, or any surprises around the election as well. But if you think of any other questions you didn't get a chance to ask today, remember, send me an email at any time to support@poweropt.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. Trial members, of course, and subscribers schedule those free coaching sessions, 45 minutes to an hour discussion with myself or Ernie. We'll be more than happy to help you. I think I had 11 coaching sessions this week, 5 on Monday. I ended up grabbing one for Ernie on Tuesday. I think I had 4. No, I had 3, on Thursday and 2 today as well. But in any case, hey, that's what we do. That's what I do on Monday and Thursday is essentially just coaching sessions, and that's great. All right. Okay, so ladies and gentlemen, you take care. Have a great weekend. Stay safe. Stay healthy. Practice the social distancing. Keep that going up as well. Hopefully we'll get out of this soon. Enjoy the weekend. We'll see you next week. I'll try to get these archived webinars out to you as soon as possible. Hopefully, I believe I can get our first section on the short hedge for Eileen probably out tonight or first thing tomorrow morning. So that'll be my target once the little girls go to bed around 9:30, 10 o'clock this evening. But until then, take care. Have a fantastic weekend. We'll see you soon. Good night.